Hi guys, welcome to today's webinar on the AI trade. Before we get into the webinar, let me give you a quick introduction to IME Capital. IME Capital is a research-first boutique investments firm with a key mission of effectively incorporating the research, depth, analytical discipline, and portfolio construction standards that are typically seen in institutional fund management for the management of individual investor portfolios. We differentiate ourselves on three core pillars: the level of our expertise, an unmatched level of transparency made possible via the IME RMS app, and the degree of portfolio customization that we do for our investor portfolios made possible via the IME investment mandate process. With that said, let us just understand the core agenda for today's webinar. We'll be covering three core sections. The first part is really around setting the context, where we look at a concept called level 1 to 5 investing, which really highlights the importance of identifying trends. We'll then go into kind of technology waves that we've seen over the future and kind of end with understanding how artificial intelligence today has moved from concept to a capex cycle. Over the second section, we will specifically examine some of the most important questions that are currently on investors' minds that we speak to. Firstly, is AI a boom or a bust? Secondly, are you too late? And what is the impact artificial intelligence could have on the India story? The last section is really focused around how investors can participate, helping you identify the investment routes that are available. And we also map the AI value chain into five distinct layers of investing. We'll go through each of these layers and understand the risk reward in each of these. With that said, let's just dive into the presentation, starting with this concept of level 1 to 5 investing. Now, what is level 1 to 5 investing? It really is sitting and trying to help investors properly understand what they have truly invested in. It's very important to understand that funds are not actual investments, but investment vehicles, what we call a level 2 investment exposure, which gives you exposures to underlying investments on a level 3 basis. This could be equity shares, it could be bonds, it could be real estate. The performance of those underlying investments, your true investments, are driven by economic growth at a level 4 basis. And economic growth, in turn, is quite heavily influenced by level 5 trends. Now, the importance of looking at things from a level 1 to 5 perspective is that when you are looking at decisions like asset allocation, portfolio construction, risk portfolio reviews, you need to really look at these things from a level 3 to 5 exposure perspective, as compared to this inordinate focus that the wealth management industry has on analyzing fund A versus fund B. The value in portfolio construction and the value in investment management is basically around identifying the level 3 to 5 trends that you want exposure to, building portfolio construction, keeping these level 3 to 5 exposures in mind, and then identifying the funds that you want to invest in. Now, why is this so important? Primarily because trends, right, and changing trends can have dramatic impacts on wealth creation across different markets. What we are showing here is the past 5 decades of data in terms of major global market performances and how they have deviated. What you are seeing quite clearly is that market leadership does tend to rotate quite significantly across decades, driven by innovation cycle, capital flows, macro regime, various other factors. For example, the 1980s was all about Asia. It was really the whole period of the Asian tigers and the emergence of Asian tigers, the most attractive economies to invest in globally. This was replaced in the 1990s with the US, driven by .com, and India, and very strong economic liberalization kind of policies around India and Brazil. As you went into the 2000s, BRICS really took over. And just look at the sheer outperformance of BRICS in emerging markets to developed markets like Japan and the US. 2010s focus shifted to tech, led by the US. And 2020 has really been all about India and tech. Now, a couple of important elements here. Your past winners can become major underperformers when trend changes. Look at Japan in the 1980s and the 2 decades of structural underperformance over 1990 to 2000. After a strong 1990s, the US actually had an entire decade with no returns. Brazil has had 2 lost decades after being the best performing markets over the entire 1990s and the 2000s. Right? You cannot, assuming that past leadership will continue in the future, is a very risky investment strategy. And it is important to understand that India has been amongst the most consistent markets globally, and this has allowed a certain level of complacency to slip in. The vast majority of Indian investors have virtually all their money linked to the Indian economy or the Indian currency. And this exposes them to a very high level of concentration risk at a level 4 basis. So, with that said, let us now kind of understand and get into the meat on understand major technology waves. It's important when we're looking at artificial intelligence, we actually see it as the fourth major era of innovation. So far, humanity has gone through four major technological eras, starting from the agricultural revolution in 10,000 BC, which led to food abundance. This shifted to the industrial revolution in the 18th to the 19th century, where goods came into abundance. You then had the information age from the late 20th century, leading to information abundance. And we are now entering the intelligence age, right? Effectively, what artificial intelligence is helping do is move us from what was an information age to the intelligence age, representing a foundational shift, moving us from an era which signified huge reductions in the marginal costs of distribution of information to a new era where you're seeing dramatic falls in the marginal cost of cognition or intelligence. And therefore, we're actually entering an era where intelligence is likely to be in big abundance. Now, a key point when it comes to understanding AI, a very important starting point is actually understanding a concept called Moore's law. Now, Moore's law basically has this one concept, and it's actually held up over many decades. Is that technology advances will help double the number of transistors that you can fit onto a single microprocessor. Now, what this does is it dramatically reduces the cost of computation, and it allows a lot of new advanced technology that was not possible earlier. Now, effectively, what this allows for is these six major tech waves that we've seen, starting from the 1970s, the mainframe era, to PCs in the 80s, internet in the 90s, mobile in 2000, cloud in 2010, and now AI, the AI era 2020 onwards. Every decade has seen a substantial transformation in technology, right? Which is driven by effectively the fact that each semiconductor can actually now compute that much more. Now, as we enter the AI era, something incredibly important is that the pace of adoption is rising more rapidly than anything we've ever seen before. The time to reach 100 million users. ChatGPT achieved this in 2 months, an unheard level. You've seen usage continue to grow across platforms, and very importantly and very hearteningly, it's not just usage. You are seeing actual revenues. Both Anthropic and OpenAI have seen substantial scale up in their kind of annualized revenue. So you're looking at Anthropic at a 44% annualized revenue run rate, OpenAI currently at a 25% annualized revenue run rate. There is very strong momentum, not just in usage, but also in terms of revenues. Now, with understanding or that background of AI and technology behind us, let us now understand a very important concept. The fact that AI is now moving from a concept to a strong capex cycle and an introduction of the core investment thesis. A very important element here is this factor of scaling laws at play. Now, basically, scaling laws in AI mean that every new model is actually being trained on a much larger amount of data, along with significantly higher energy and hardware costs that is supported in training the model. Now, the race for superior models and better intelligence is therefore intrinsically tied to a race for access to higher computing power. For AI to be intelligent, it needs substantially more data, needs substantially better computing. These are very large spends happening in extremely complex AI data centers. And to understand how to invest in the AI theme, you really need to deconstruct this value chain. The AI stack is not a monolith. It's a complex ecosystem of interdependent layers, each with distinct economic characteristics and different players. Now, the reason this is becoming so attractive is that AI is actually driving the largest investment cycle we have seen in modern times, with investments across software, semiconductors, data centers, power, multiple other areas. It's not a single company story, it's a global supply chain phenomenon where the bottleneck is no longer software, it is compute, it is data centers, it's energy. Now, what you are seeing is a humongous scale up in the capex being undertaken by top five cloud hyperscalers. You are seeing what used to be a $150 billion annual spend in 2023 has risen to 723 billion of estimated spends in 2026. Over $1.5 trillion is going to be spent by cloud hyperscalers over the next 2 years alone. Now, this historical unprecedented capex cycle is leading to a major reindustrialization capex wave across a highly concentrated and controlled computing and support ecosystem industry. And effectively, on the back of this very strong $1.5 trillion capex wave, you are seeing huge outperformance across all AI focused stocks and funds and stocks, and that have significantly outperformed the broader market. Now, coming to probably the key question across global investors' mind. Does AI represent a boom or a bust? In this section, we will attempt to look into the future and evaluate different scenarios. Now, effectively, this is the $1.5 trillion question. You're going to be spending $1.5 trillion setting up AI data centers over the next 2 years. Global data center capex is jumping by 3 times in just a 2 year period. Will incremental demand come in to absorb the supply? If the answer is yes, strong demand comes in, giving visibility on ROIs on AI capex, allowing an aggressive capex wave to continue. You're going to be in an AI boom, and you're probably going to be looking into a scenario where you may be spending over $1 trillion in a single year on AI data centers. However, the flip side to this argument is that if data demand does improve but less than the amount of supply, you will have increased uncertainty on the ROE on this capex. You'll also have overcapacity having been built out, leading to a sharp fall in capex spends, which could be a AI bust. What of these two outcomes is likely to be the outcome is really what we're going to be focusing on, and it's a $1.5 trillion question. Right now, is demand likely to increase by 3x or more? There are many reasons to kind of believe that yes, it would. Firstly, AI adoption is still at fairly early stages. It's only year three since its launch. Less than 10% of mobile users are currently using AI actively. Major growth drivers are still at very infant stages, less than a year's old. Enterprise use cases, AI agents, parallel agents, autonomous agents, AI everywhere. Multiple areas, all with a lot of traction behind them, all still very, very nascent. Big tech companies are going to keep trying to work on newer models, each of which need higher levels of compute. And across enterprises, software firms, governments, being left behind is a sure existential threat. Right? So there are enough factors to kind of believe that demand can surprise positively. But it's important to understand that demand could also disappoint. Right? Because you do need a big explosion in demand in the context of the amount of incremental supply coming in. Hallucination and real world issues could lead to AI usage being significantly lower than what is being expected. Customers may have a lower willingness to pay for new, modern, more expensive frontier models, and therefore use kind of older models which don't use as much compute. And demand could increase, but less than the level of supply. Now, to a broad level, we are less concerned about the first two issues. We believe better prompting, better understanding of how to use AI, things like what you're seeing with Claude skills, MCP servers, a lot of this stuff is actually helping better control AI responses. Willingness to pay, you already within 3 years seeing paid plans, premium paid plans, fairly high AI related spends already emerging, right? So I don't think this is as much of a concern. The more realistic threat is that you're putting in humongous incremental supply, demand increases, but not enough. Right now, you do have a parallel example of a bust that happened for something very similar. This is really the fiber optic bubble that happened during the dot com era. And the reason we look at fiber optics and not dot coms is it best represents the infra kind of tech infra structure that we kind of really focus on in the AI wave. So, what you saw during the dot com boom was a huge capacity build out of fiber on anticipated demand. However, actual demand hugely undershot estimates. Not only was actual demand lower, but then you had kind of dot com valuations collapse, resulting in bankruptcies and a lot of firms not having funds to grow, which further aggravated that problem. It led to capacity utilizations, especially in fiber, collapsing. 3% global capacity utilization was the actual bottom, and it took almost 2 decades for all this fiber that was laid out to actually be used, leading to humongous value destruction. Over 80% on the NASDAQ, over almost 90% on Cisco and WorldCom going bankrupt. These are some of the most prominent companies at that time. Now, when you look back in hindsight, you could identify clear red flags. There were unrealistic demand projections, negative cash flows from customers with a very high level of funding dependence, and importantly, fiber capacity was very easy to roll out, and the economics of how you roll out fiber actually is very supportive of building out overcapacity because it doesn't cost that much more to lay incremental fibers within the same cable that you anyway string all around the world. Right? So there is strong economic incentive to drive overcapacity. Now, are we seeing something similar in AI? Not as per us. We believe the demand projections are more believable. There is clear visibility of growth opportunities. No new infra is needed to be built out to reach the end consumer, unlike the dot com period, right? Where dot coms were there, but most users didn't have PCs and mobiles weren't yet there for people to access the internet. Uh, there's also no benefits of building overcapacity, unlike fiber. And there are also very large capacity constraints that exist in the ecosystem that will prevent an overbuild, even if people want to do it. While your AI model makers have some similarity to dot coms, they are still loss making, they're negative cash flows, they are dependent on funding. It's important to understand that they've achieved monetization significantly before year two itself. And in the low probability event that one of the leading frontier models were to kind of have a funding challenge, we believe there's a huge acquisition appetite by all the big tech firms for this. And accordingly, while we do recognize the fact that there is a clear risk that when you are sitting and going through a major capex wave, that you could overbuild. And if you do overbuild and you have overcapacity, it does lead to a deep, prolonged recession, big drops in capex, and also big falls or humongous value creation destructions. So this is a risk, but in our view, AI resembles a bit closer to what we've seen in the cloud computing era from 2006 to 2022. It starts with something similar, a huge infra build out on unproven assumptions. With the case of cloud computing, it's really an unproven assumption that enterprises will migrate from on premise towards the cloud. At that point in time, there was huge uncertainty around this. But the difference here is you actually did see huge demand responses to this capacity build out. Enterprises saw large benefits of moving to the cloud, and a lot of new cloud enabled apps actually came about. Because you saw the strong demand response, it allowed capex to continue to increase, and we are currently in the 15th straight year of continued hyperscaler growth in capex with no visibility of a let up in demand yet. And it's resulted in tremendous value creation across big tech and apps. Now, what worked in the case of cloud hyperscalers? Firstly, enterprises saw large value and were willing to shift. There was a clear value proposition. There was no overcapacity built out upfront. Capacity came in, it got used, new capacity got built. We see fairly similar signs in AI. There are large capacity constraints that will prevent overcapacity. There is strong value propositions that we believe that will drive adoption, not just across enterprises, but enterprises, individual governments, and more. We're still in very early stages of adoption. And there are clear, strong indications that demand should emerge as capacity becomes available, allowing this favorable virtuous cycle. Now, what happens is that when you are setting up large capacity and if that capacity gets utilized, it results in this great period where or this virtuous cycle where capex can keep moving up and also tremendous value creation can happen in that ecosystem. So, in the case of kind of cloud, you've seen corporate data move from 5% of corporate data in the cloud to 60% from 2012 to 2022, resulting in between 30 to 40x returns across major cloud hyperscalers. Effectively, it comes down to this. AI capex is tremendous capex happening. Will it continue? Will it not? Are you going to be, is it going to resemble the cloud era where it's a multi year structural story with tremendous value creation? Uh, the answer is yes if demand comes in a very big way. However, if demand disappoints, the overcapacity could lead to a major bust similar to what we saw during the dot com. Now, what makes us so confident, or what makes us at least confident that it's a lot of signs seem to indicate it's the first and not the second? Firstly, we are still in very early stages of AI adoption. We are in just year three of commercial AI, compared to 25 years for the internet and 15 years for smartphones, and both of these continue to see year on year increases in adoption. Large penetration within existing kind of users who can access AI. Less than 10% of mobile users are currently actively using artificial intelligence. There are multiple identifiable growth drivers. Apart from just, and all of these are kind of all working in parallel. You'd have growth, just sheer growth in number of users, but there can be big increases in usage by existing users. Enterprise workloads are largely untouched. Agentic AI applications, parallel running agents, autonomous agents, agents in AI and everything. All of these are new incremental areas which can lead to tremendous amounts of growth in terms of demand for computing capacity or AI tokens effectively. Now, it's important to understand individuals and enterprises take time to get used to new technology. And as they get more used to the new technology and understand how to adapt their workflows to using the new technology, you tend to see big increases in demand. This is something that we've seen time and time and time again. Uh, Multiple times, there's an old way of doing businesses, of doing things that actually constrain capacity. Tech revolutions come in, leading to huge increases in supply. But then, what is important is demand explodes very often to levels unimaginable prior to the tech revolution. And it also creates new industries with a tremendous amount of value creation. You've seen this when horse drawn carriages move to railways and cars, leading to an explosion in the amount of kilometers traveled. When print TV and movies move towards the internet and smartphones, resulting in an explosion in the amount of content being created globally. Or as you move from on premise in house IT towards the cloud, resulting in tremendous amount of growth in computing power available globally. These are just three of many such examples. We've seen something similar when it moved from film to digital. The sheer explosion in number of photos taken, the number of meetings that have happened when it no longer needs to just be physical, but it can happen virtually via something like Zoom. The sheer explosion in communication when you move from having to send physical letters to email. Time and time again, it has been shown in a big new tech wave, right? You set up huge increases in supply, if valuable, can lead to explosions in demand, right? That effectively lead to a tremendous amount of value creation. And when you look at artificial intelligence, there's just so many signs of this. These are just some examples that we put together in terms of areas we are seeing a lot of demand emerge. 7 billion individuals globally are going to be enhancing all the images and videos doing using artificial intelligence, having artificial AI doing their work, studying for them. Any question that comes to their mind, they're going to be asking artificial intelligence, ranging from the most important to the most stupid questions. 2 billion of these actually working professionals who would end up using AI quite extensively at work. There are over a million MSMEs who will be augmenting their IT, finance, operations, customer service, marketing, content creation, and other departments, all with AI. There's going to be a whole new generation of AI first startups across every single industry. You're going to see a startup wave of companies which are built AI first, very often by new college grads, which are trying to disrupt existing businesses. All your big tech companies are going to be demanding more and more compute requirements to support the next generation models. 195 governments struggling to not be left behind in the AI race when it comes to defense, surveillance, the desire for sovereign models, wanting to keep data in house. AI is going to be incorporated in everything. All software is already starting to get AI enabled. We believe most products in the future are going to be AI enabled. You'll have AI enabled cars, home appliances, entertainment. Very importantly, going forward, there are certain known token hoggers. Your deep reasoning models, your world model, parallel autonomous agents, a lot of the AI agents that are currently being developed, all of these require much more computing power than the kind of chat interfaces that we're currently using to interact with AI. There are multiple areas that we see that demand could explode, and this really is what gives us the level of confidence. And effectively, theoretically, this is what we're trying to answer. Is this a fundamental boom? Is this a speculative bust? And I think that comes down to, is demand real or is it just projected? Is infrastructure going to scale with utilization, or are you massively overbuilding infra? Is cash flows available to fund the next cycle, or is it all debt funded capex, very dependent on revenues? Are the new applications coming in? How commercially viable is the ecosystem? When you look at artificial intelligence across multiple parameters, it does seem to clearly seem to point towards it being more of a fundamental boom than a speculative bust. Though it's important to understand that you can't ignore the fact that there is clearly a risk that this could all actually turn to a bust if demand doesn't actually come in. Now, if you do believe that AI is interesting and worth investing in, are you too late? Right? Have equities already moved too much? Now, it's important to understand that the larger moves on the AI trade are just 1 to 3 years old. Commercial AI was only launched in CY23 with the launch of ChatGPT, and even then, it was largely just a curiosity. CY24 is when the larger AI capex really started beginning and GPU shortages became a bigger thing. Right now, if you're seeing CY 24, that's when your NVIDIAs and your Broadcoms and all were moving. But other key parts of the AI value chain really, and especially if you look at the underperformance in the previous 2 years, really hadn't moved too much. CY24, even when these capacity constraints are known, you still didn't have a move. It's only CY25 onwards that the entire value chain has started to actually move. And if you had to identify a single point, I think OpenAI's Stargate announcement, where they announced a $400 billion capex and 7 gigawatts of AI data centers, is when people realize just how significantly or how big this AI capex wave is, how big the constraints are, and this is where the $1 trillion plus started kind of getting thrown around. We're sitting in May 2006 right now. This is just some 7 to 8. It's less than 9 months old in terms of the start of the major part of this theme. Secondly, right, while you are not buying at the absolute bottom, and honestly, it's just extremely difficult to ever do so. Uh, if you're in a structural bull market, buying even after larger moves is typically not a concern. And we kind of taken the cloud era as an indication. So if you look at Google, Amazon, Apple, and Microsoft, what happens if you bought it 3 years after the cloud era started in 2010? So you're buying it in 2013, or you bought these stocks after they had gone up 3 times from the 2010 start. If you see you're still making very large multi-bagger returns simply because of the strength of the cycle. If the cycle is extremely strong, buying after a large move is typically not a concern because there's still arguably large moves up ahead. Again, if you're looking at actual fundamental business momentum, the revenue momentum is also fairly recent. Look at the difference between the 23 to 25% revenue CAGR versus what you saw between 20 to 23. Big step up in growth only over the last 2 years. This is a new earnings driver, not a mature one. And very, very importantly, because kind of you've seen such strong growth in these underlying companies' businesses, while these stocks have moved up, valuations are still not exorbitant. You can actually buy the vast majority of direct AI thematic plays globally at valuations that are cheaper than the vast majority of Indian consumer companies, none of whom have this level of growth dynamics. Even valuations at a market level, while not necessarily extremely cheap, is also something that is not very exorbitant. Yes, these stocks have moved, but they've moved on the back of fundamental growth in businesses, not just on the back of a valuation re-rating. And therefore, the core call is, does this fundamental business growth continue? If yes, we believe that we're still in just year two, year one, year two, year three of a multi-year growth cycle. So effectively, to sum it off, this is our view on the AI trade cycle. It's important to understand that predicting the future, especially in the midst of a major technology revolution, is always subject to large risk. We acknowledge the sharp price run ups and the risk of euphoria, but IME's view is that AI is closer to a fundamental multi year bull market as compared to a speculative bust waiting to happen. It remains a high risk and a highly volatile investment. But we believe that AI represents what is arguably the most attractive global investment opportunity today. We are currently actively recommending investors with the right risk appetite to participate in the AI trade. So I think that covers our view in terms of AI and the risk of a bull versus a bust, and at least our kind of view in terms of the overall thesis. Now, let us look at another very important question that we believe all investors need to answer. What could be the potential impact of artificial intelligence on the India story, and what is the right allocation percentage in that perspective? Now, there is a very important indicator, right? And if you're just looking at how foreign investors are behaving, why are foreign investors pulling out from India? It's the first time ever since the early 2000s, when I started my career, that we've seen 4 straight years of FI outflows, with CY25 being the highest ever annual number. Right now, and this also resulted in fairly strong pressure on the currency. Now, in our interactions with FIs, two primary reasons clearly emerge. Firstly, what AI has moved to become the hottest trade globally. It has replaced India as one of the best investment opportunities globally. And India gives you virtually no exposure to the highest growth that we're seeing across the world. The second, and this is a larger, longer term concern, is, could India be an anti AI trade? And I think the concern here is that with India has the highest share of at risk services. Could AI lead to unemployment, impacting income, impacting consumption? And this great demographic dividend that we talk about, which kind of assumes that there are jobs for the youth that are graduating from colleges, giving them income and money to consume, do they kind of become unemployed, and therefore this demographic dividend becomes a demographic curse? We don't believe this is going to happen, but people have started asking this question. And the moment there is uncertainty premiums that start getting associated with the market. And that becomes a problem when you're one of the most expensive markets in the world. Now, you're already starting to see some of these tremors in Indian IT services, right? Effectively, the concern here is that as AI increases the productivity of your employees, you can actually achieve the same amount of computing, of software development with a much smaller employee base. And if these productivity benefits are passed on to the consumer, which often does happen in a competitive market, you'd see a big deflationary impact. And this is where you're seeing kind of almost a one-third correction across leading IT companies. Uh, it is very important to understand that this is not the only possible macro path. There are multiple scenarios that could emerge, and you really need to try thinking about this in probabilities. AI can both be big time negative for India and can also be hugely positive for India, actually improving the India story from what we know today. The negative path basically follows a narrative that AI and automation leads to job displacement, impacting income, impacting consumption, which because of second and third order impacts, which we'll discuss in the subsequent slide, lead to slower economic growth. However, there's also the polar opposite, which is a positive narrative. India has a high share of labor, of skilled labor, in areas which AI could come into. If AI is going to make skilled labor that much more productive, India becomes that much more productive from a global perspective. If you see this big demand response in terms of that much more demand for software and BFSI services and all of that, you may not actually see job displacement because you're seeing that much more demand come in. But because each employee is that much more productive, it allows for higher levels of salaries, allowing for a higher level of income than what we were earlier expecting, resulting in even stronger consumption demand and an even stronger India story. Is AI positive or negative for the India story? You can strongly make both cases. We will know this in hindsight as we go 7 to 10 years down the line. However, why are we currently focusing on this negative point? I think the primary reason is the vast majority of investors, especially Indian investors, have almost 100% concentration to the Indian economy and the Indian rupee. The positive path is only going to help them. But if the negative path were to unfold, right, the entire portfolio can be at substantial risk. And if you understand the negative path properly, you'll understand there's really no place to hide. There's clear first order impacts on IT, on BPO, on BFSI, on skilled professionals. But that would lead to a second order impact in terms of lower real estate demand, lower discretionary spend, lower auto demand. Now, as this bunch of sectors start getting negatively impacted, you start having systemic effects in terms of a third order impact. Impacts on direct tax revenues, banking credit, government, the government's fiscal space will get constrained. If we were to go down the negative path, there'd really be no major place to hide. And the AI trade could actually provide a very strong diversification from effectively the biggest risk currently to the India story. It's very important to understand that you don't need to get too negative. There could be positive outcomes, there could be negative outcomes. But effectively, what we are calling for is a structural change in the level of international allocations that we consider appropriate for an Indian investor perspective. We believed 2 to 3 years ago that 10 to 20% was the right amount. India still being the core bet, being the most attractive market globally, international being a bit of a risk control and ability to participate in some of these more attractive themes. We believe a 20 to 40% allocation today is a little more prudent. It gives you actual diversification as compared to just a thought of diversification, but 10-20% is really not giving you any diversification benefits. We can actually even envisage a future where if AI were to have big negative impacts 5-10 years down the line, you could have India being a minority position in most Indian investor portfolios, very similar to what you'd see in French portfolios, German portfolios, or Middle Eastern portfolios today. Effectively, it's really a case of scenario planning and the kind of probabilities associating to each. But there is a scenario where AI has a limited impact. Actual AI usage disappoints, AI capex ends up being the bubble. There's a huge crash and value destruction on the AI trade, and India comes back to the global center stage. The polar opposite of this is the negative impact. AI becomes mainstream, leads to large unemployment, leading to a crash in India and the AI trade being the global center stage from an investor focused perspective. And you also have a bit of a middle ground where AI does become mainstream. There is large incremental demand that helps mitigate unemployment risk. Humans move to higher skilled roles, and both India and the AI trade kind of do quite well. I think our biggest point here is that this historical complacency that Indian investors have come to, driven by these 5 decades where India has consistently performed, right? Allowing Indian investors to believe that 100% allocation to India is fine. We believe that there is an emerging threat which is important to diversify from. We continue to see India as one of the most attractive markets globally, but is 100% of your portfolio exposed just to the Indian economy and the Indian rupee? Is that prudent? We believe not. Uh, and we almost are arguing towards a 20 to 40% allocation towards international investing. Now, what is the exact percentage? That really is an individual decision to be made one on one between the investor and the private banker. Coming to the third and the final part of today's presentation, which is exactly how do you go about investing in the AI trade, especially for Indian investors. Now, Indian investors have three broad routes, and we have a clear preference towards one. Strongly recommend any investor against trying to participate via any US domiciled broker, giving them access to US domiciled underlying funds or investments. What happens in this case is you get exposed to inheritance tax or estate duties in the US. If the investor were to pass away, 40% of all assets held above $60,000, right, is effectively taken away. This, according to us, is a risk that really doesn't make any sense and strongly advise any investor from taking on an estate duty risk. Indian feeder funds were an attractive option until recently. While the number of options were limited and you can't do things as sophisticated as when you take money overseas, uh, they were very easy to operate. However, what happens is there is an overall RBI limit. This limit has been consistently getting breached, and therefore these funds very often don't accept fresh subscriptions. Our clear preferred recommended route is using a Singapore based platform. This is a Monetary Authority of Singapore regulated investment platform. The benefits here are your assets are legally held outside India. It's an actual dollar return, an actual dollar which you can transfer to other dollar bank accounts in the future. It gives you protection against estate duties because we have actually done the homework to ensure we can identify non-US domiciled funds that are giving you exposure to all of these most attractive themes. You're kind of getting the best of all worlds. You get exposure and you can really cherry pick your exposure. Uh, Easy online platform, and importantly, avoid needless complications around inheritance tax. Gift City, while an option, is still yet to mature, and the number of options available there are still very, very restricted. We can do much superior investing out of Singapore as compared to Gift, at least at this point in time. Now, another point when it comes to AI investing is we strongly recommend investors against taking direct equity exposure, especially in the context of what's going to be coming up in the subsequent slides of the session, where some of these stocks may seem very, very tempting. It's important to understand that AI investing is extremely complex. There are multiple layers involved, extremely rapid technological shifts. Winners today could be big losers tomorrow. Very high levels of capital intensity with potential for delayed returns, geopolitical supply chain risks that need to be factored in, cyclical sentiment, monetization uncertainty. This is not an easy space to be on top of. Active fund management is key to navigating a dynamic environment. The last part is when you are trying to translate AI investing into investable portfolios for end investors, you really need to understand what part of the value chain you want to invest in. And we'll cover this in much greater detail in our next section. But you could get core growth exposure where you're buying US technology funds, giving you exposures to model providers, semiconductor design firms, cloud hyperscalers. Or you could choose what's called, or what's very often referred to as a pick and shovel infra. You don't buy the front end guys, you buy the guys who are giving the computing, the actual equipment to these front end guys. So you're buying the semiconductor manufacturers, the memory manufacturers, the networking firms, etc. Or you could choose certain geographies and certain materials which have big benefits from this theme, or go to the AI end user and innovation funds. Each of these options exists, each with different risk rewards. We'll explore all of this in the subsequent session. So let us now map this AI value chain and understand where this $1.5 trillion is being spent. You can identify 5 distinct layers. Layer 1 is really the AI model developers and the cloud platforms. These are companies like Google, Anthropic, OpenAI, Amazon, etc. You then have the second layer, which are basically the firms that provide the hardware to these front end model providers and cloud hyperscalers. Firms like NVIDIA, Intel, TSMC, Samsung, SK Hynix, etc. This can also be broken up quite clearly into two segments, the IP owners and the manufacturers. We'll come to this when we go into layer 2. You then actually have this whole physical infra layer, which has nothing to do with traditional tech. It's really about real estate, electricity, cooling. When you're going through this layer, you'll understand why there's such a big opportunity in this physical infra layer. There's also a very important layer around materials. There's certain essential raw materials that, given the explosion in demand, that some of these are likely to be in big shortages, and you could see big price movements here. And you finally have a layer of the end users of actual AI and the actual AI models. Which of these layers you want to participate in and how you want to construct your portfolio across each of these layers is one of those other really important strategic questions that we believe investors need to focus on answering. Now, let us understand the first layer, which is the model developers. During the gold rush, if you were a gold miner, you may or may not have made a lot of money, and chances are that you wouldn't have made money. But if you were selling picks, if you were selling shovels, if you were running hotels, the support industry actually exploded and a huge amount of value was created there. When you're talking front end model developers, we'll also show one layer within the kind of second layer. We'll talk about the IP owners of semiconductors. There could be big winners, big losers here. The level of risk reward here is a lot higher than when you're looking at kind of the semiconductor manufacturers, the memory manufacturers, etc. So when you are looking at AI model developers, it's important to understand that big winners and big losers could evolve here. However, predicting this is just incredibly difficult, and you are kind of seeing leadership change around quite dramatically, and very difficult to predict who the longer term winner is likely to be here. It does remain a core holding, however, because ultimately this is where a very large amount of the value creation is likely to happen, assuming AI does actually do well. The second layer is really around all the computing power, the computing infrastructure that's actually required to support this growth. Now, effectively, this layer is around computing hardware, and you can break it up across multiple different components. And what is incredibly important, especially in the context of $1.5 trillion being flowing down across this entire value chain, is just how concentrated this value chain is. When you come to semiconductor design firms, the IP or the intellectual property owners of semiconductors, the biggest or the most recognized name here is NVIDIA. Now, it's so well recognized because it accounts currently for 92% of data center GPUs used in artificial intelligence. They are the big leaders when it comes to artificial intelligence semiconductor chips, with Google having recently caught up, but not caught up all the way. Right? This again is going to be a space where one or few companies may dominate while other companies may struggle. But again, big value creation could happen here. Now, when you're talking about value creation, it's important to understand uh, when you are seeing stocks move the way they are, they're moving on actual fundamental growth in businesses. Nvidia's quarterly revenue run rate, which was about $7 to $8 billion in early 2023, has moved to over $55 billion, right, in just under 3 years. It is an exponential and a crazy kind of growth that we've seen in terms of actual revenues. Now, you see similar signs across the entire value chain. Now, while your semiconductor design firms own the intellectual property, they don't actually manufacture semiconductors itself, primarily because semiconductor manufacturing is incredibly capital intensive. A single advanced semiconductor fabrication line costs anywhere between 15 to $25 billion. And again, here there is a clear global leader. TSMC dominates the 3 and 2 nanometer chips, which are essential for AI data centers. And They kind of account for over 70 to 80% of the semiconductor market share globally. You have kind of seen a similar explosion in revenues for TSMC, resulting in a large increase in capex, with a lot of industry participants believing that the capex increase is not enough and it will become a source of capacity constraint because the demand explosion is actually well ahead of this big increase that you have seen in capex, right? It's a $10 billion capex moving to over 50 billion, but most people believe this is still not enough. As you flow down this chain further, who are the equipment suppliers to this capex for companies like TSMC? You get to this company called ASML, which is considered the most critical bottleneck in the entire AI value chain. It has 100% global market share ex China. It is a global monopoly when it comes to the equipment required that goes into the manufacture of an advanced fabrication line required for artificial intelligence, especially a EUV form of equipment. Right? So, again, big, highly concentrated kind of value chains here. Memory, which is again extremely important, especially high bandwidth memory. SK Hynix is the global market leader here, but SK Hynix, Samsung, and Micron pretty much dominate the entire memory market. Networking and AI data center integration, players like Dell, Supermicro, Arista, all of these are all companies which are seeing huge demand booms. So we see layer two, especially the manufacturing layer, as an very attractive layer for investors to have exposure to. But physical infra, layer 3 itself, could actually throw up some very interesting investment opportunities. You have seen huge stock performance in a number of these companies, which, and if you actually look at the stock performance of Vertiv, at least as of the time of this webinar, it is the second biggest wealth generator after Nvidia over the 5 year period amongst all AI related stocks. It manufactures cooling equipment. So just important to understand that you set up a data center, you are going to need a lot of electricity. And to understand, when we're saying a lot of electricity, a single large AI data center can consume as much power as a mid-sized city. The amount of electricity used by AI data centers is just crazy. You require really sophisticated cooling equipment, and you also need a lot of really specialized physical real estate that can house these data centers to be built. Just to kind of put some of these numbers in context, data centers already, as of today, are responsible about for 415 terawatt hours of energy demand. That is 1.5 times the amount of demand of UK as a whole, almost equal to France. If you're looking at projected demand by 2030, you're looking at demand which would be more than that of Japan. Half of India's electricity demand would just be used in AI data centers, right? It's a explosion in the amount of electricity that is required, and therefore the entire electricity value chain globally is going to see a humongous reindustrialization capex wave. All of this is going to need materials, especially specific types of materials, and therefore you're seeing large moves in these uh, commodities as well. Rare earth materials being the most clear beneficiaries, but even materials like copper, silver, other conducive metals, specialty steel, industrial gases, high purity chemicals. There are specific materials required for certain types of semiconductors, memory, networking equipment that go into parts of the electricity grid, etc. A lot of these are going to see unprecedented levels of demand and therefore potentially very large amount of value creation. Finally, is kind of the fifth layer, which is the end users and edge AI. What you are likely to see is the ultimate economic value of AI is likely to accrue to businesses that actually successfully embed intelligence into their products, workflows, and decision making systems. It could be traditional firms that are using AI to become a lot more productive. It could be AI native firms that are sitting and trying to disrupt existing industries, or it could be new, altogether emerging use cases that could not have been possible before AI existed. But there is also likely to be a lot of value creation here, right? Effectively, now, just one other way of looking at it apart from layers is that there is a tremendous level of concentration at a geographic level itself, which makes certain region or geographic funds quite interesting. US is the clear winner when it comes to the AI models, the IP, etc. You want to play the pick and shovel value chain. Taiwan and South Korea just dominate. China could be a big dark horse play on AI with a lot of lack of visibility, but a lot of interesting stuff happening there as well. Now let us understand how we basically use the IME RMS, right? And what the IME RMS is and how it could actually be used to help you identify really which part of the value chain you really want to play. Now, a key part around trying to sit and do portfolio construction from a level 3 to 5 perspective is understanding that there are these different kind of asset classes and categories across both international and global, right? And you really need access to not just data, but also insights, stances, what kind of risk profile these are appropriate for. All of that information is all available. And when you are looking at a particular category, if you click through on that category, you see our recommended funds. When you click through on a particular, say, fund, you actually get to understand our rating and our rationales for our rating. This is something no investment firm in the country provides. Not only do you effectively get the ability to navigate and identify things on your own and just get access to a lot of information, but if you are kind of going to the fund section, right, and this is really the context of the AI trade, if you go into the recommendations, we actually have the top fund ideas in the AI trade. And out here, you actually get across each of the layers. Within US tech funds, what are the funds that we are recommending? Within computing infra funds, what are the funds that we are recommending? The country dedicated funds, the electricity funds, the commodity funds, AI end user funds. Very often what happens is certain funds may seem very attractive in concept. And if you sit and show someone a 125% kind of return from a 1 year perspective, very often investors may want to sit and say Vanik rare earth, right? It sounds like a great or very interesting opportunity. However, it's important, like if you sit and click on it, you'll immediately. So this is the way the platform works. If there's a problem, you'll see this in red, right? And you scroll down, and yes, recent performance is low, but look at the level of volatility this fund has. It's the kind of volatility that most investors will not be able to envisage. So, really, the idea is one, to make it a lot easier for you as an investor to really understand what all your options are. And when it comes to those options, ensuring that you have in front of you the right data and the right insights in order to make the clear and the appropriate decisions. It's very important to understand that for the vast majority of our users, they aren't going to go and sit and do this research themselves. That is not the idea. The idea of this is to help improve the quality of discussions between yourself and the private banker. It is not that you sit and kind of be expecting you to sit and handle the complexity of figuring out all of this, but it helps create a really structured manner around portfolio construction and helping ensure that a central point of truth, clarity around what we like, what we don't like, and what investors need to know. I hope you found the content and the information useful and it helped give you clarity around the fact that AI trade is an emerging and very attractive investment opportunity. It is something that we believe investors should consider as part of their overall portfolio. And portfolio construction really needs to be looked at quite closely. And the moment you start looking at portfolio construction from a level 3 to 5 lens, the kind of lens that most fund managers or asset managers look at portfolio construction, you start to see big fundamental issues with 100% concentration to a single country and economy. Obviously, we can't sit and create customized or can't give customized solutions on a public webinar. But if any of you are interested to understand or evaluate this more for your own specific portfolios, please feel free to get in touch with us. you can either just drop us a WhatsApp on 8088770050, or if you're actually interested in taking a spin off the IME RMS, we actually offer a 15-day free trial, which includes 3 fully complimentary 1 hour consultations with a private banker, where the private banker will sit, understand your requirements, build out your mandate, help you build a financial plan, identify what parts of the global economy we need to be building out a portfolio from, and give you a clear investment plan tailor made to your specific requirements, including how to participate in the AI trade.